Welcome to Upticks. I'm Jake Falcon, the founder of Falcon Wealth Advisors and your host of Upticks. Today is episode 174, Overcoming Inflation. Thank you all for joining me back on another episode of Upticks. I hope everyone out there is staying safe and healthy during this horrible pandemic. For today's topic, I wanted to bring in real client stories as part of my new segment on my show. And as I've been having review meetings with many clients here lately, a very common theme has been presenting itself. Jake, what are we doing about inflation? So I thought that might be a perfect topic for our next episode of Upticks. So first off, though, I want to talk about inflation because I think many people, probably from the media, or maybe they remember the 70s or 80s when interest rates were really high and inflation was rampant, feel like inflation is a bad thing. And I'll tell you, actually, inflation is not a bad thing. In fact, it's a good thing as opposed to deflation. See, when you have deflation, that implies that prices and the economy and things are shrinking. And you actually don't want that because that's when you start to get high unemployment numbers and companies going out of business. And when companies go out of business, the stock market shrinks and your investments shrink. So yes, goods and services may be cheaper, but you don't have as much money in your pocket to pay for those goods and services. So it's always a trade-off. As it stands with inflation, though, when goods and services go up in value or cost, so too does typically your investments. So as long as your investments are properly aligned to help you overcome inflation, it's actually not a bad thing at all. But I want to talk about some things that you can do today to help protect yourself and your family and your portfolio against inflation. Okay, so first off, just diving right into the investments, typically many clients have a good amount of money bulked up into their savings accounts, right? Whether that's $30,000, $40,000, $50,000, $100,000, $500,000. Now, one thing that can help you overcome inflation is not having too much of your savings in cash. You see, that hasn't been a problem over the last decade because we haven't had much inflation. But if you have a significant portion of your nest egg in your savings account, you're actually setting yourself up to have a negative real return. And by real return, I mean net of inflation, because the banks still aren't paying much in interest at all. But it's a dilemma. It's saying, Jake, I get it. I hear you, but I don't want to invest this cash because A, you may need that money in the next 6 months, 12 months, whatever that may be, and you don't want to risk it. Or two, again, you don't want to stomach volatility. You don't want to put it in the stock market because the stock market goes up and down all of the time. So what do? Well, I've got actually two solutions for you. One is, in my opinion, not as good as the other one, but I just think I should at least throw it out here on today's episode so that you're aware of it. And it's something that you can actually buy through us at Falcon Wealth Advisors, but we're not doing it. And it's buying TIPS, or what Treasury Inflation Protection Securities. So they're a type of government note or bond or something that you can invest in. And the idea is the price of these TIPS will typically increase if you have inflation, which in theory sounds like a really good idea. Say, okay, Jake, I'm going to buy this government bond. If inflation gets out of control, my bond is going to, maybe my interest will actually appreciate with inflation. What's so wrong with that? Well, the problem that I have with TIPS today is that if you buy one of them today, your actually yield on it currently is negative, literally negative. So you put money in and you get a negative return. And I don't like that. And yes, I think inflation has already presented itself, and I think it's going to continue to creep up and get some more momentum. But I don't like going into an investment having to have inflation in order for us to get a positive return. So we're still steering clear of TIPS. I'm going to tell you what we're doing exactly for our clients here in a few moments. But I just wanted to throw that out there. That's why we're not buying TIPS, is because, again, they're a negative return right now. So I don't want to put clients' money in TIPS only to have, if we don't have inflation at the rate that we expect, a negative return for them. To me, it doesn't make sense. Something that I think is actually very fascinating, though, that you can't buy through us at Falcon Wealth Advisors are something called Series I bonds. Now, this is a very interesting phenomenon going on with Series I bonds, and you actually buy them literally direct from the Treasury. There's a website called Treasury Direct that you can go out there. And again, if you have questions, send me an email. My email is just jake@falconwealthadvisors.com. But these I bonds are issued by the government. And what I love about them is currently today, as long as you buy them before May, so again, I'm filming this in December of 2021. If you buy one of these bonds before May of 2022, they're yielding 7% interest. Yes, that's not a glitch. 7% interest out of a government bond. Now, there are many stipulations though that come with it. One, as an individual, you can only put $10,000 in any calendar year in a Series I bond. But because we're at the end of the year, you could literally buy $10,000 worth in December and another $10,000 worth in January. And then if you're married, your spouse can do the same thing. So that's pretty fast. So you actually can get, if you're a married couple can get $40,000 in there relatively quickly, earning 7%. Some of the other caveats are you got to keep the money in there at least a year. And if you sell it before 5 years, you have to give up 3 months or so worth of interest, right? So you got to be cognizant of that. But again, this is a 7% annual return from the Series I bond. It's direct. Again, it's an online type transaction through the government. So there's not like you necessarily write a check or you can't deposit cash. I don't think it probably needs to come from some sort of financial institution. But again, it's a great opportunity out there. Now you need to be aware that the interest may be subject to taxation still. So they're not necessarily tax-free. But the point is, if you said, look, I've got 50,000 in my savings account, Jake, earning 0% or 0.1% interest, something to consider would be to potentially take 10,000 of that savings if you're not going to need it, again, in at least a year, right? Because again, if you sell before a year, I think you forego interest, so there might be other issues. But so again, you're not going to want to put money in there that you may need within a year. But again, putting it in there in a year and you're going to get 7% return is a pretty sweet deal, right? So, and certainly if you're not going to need it for 5 years, it's even a better deal to do that. So I would encourage you to investigate Series I bonds. And again, as a fiduciary advisor, I don't get paid anything if you go buy a Series I bond. I'm just looking out, again, for our clients' best interest. And I think it's a great opportunity that if you've traditionally bought CDs at the bank and you're tired of them not paying anything, or you've got a lot of money in your savings or checking account and you don't necessarily need to have it all there at this moment, go check out those Series I bonds. It may be something that you and your family can benefit from. It does make your situation a little bit more complex because, again, you're opening up another account, something else you need to monitor. So again, if you do that and you're a client of Falcon Wealth Advisors, please let us know because we'd like to update your financial plan so that we have that linked up. And then every time that we review with our clients, we can also review your Series I bonds held through Treasury Direct. Pretty cool. I think it's a fascinating opportunity. And I think it's something since I believe it's 2000 that the rates haven't been this high, and it's because it's based on inflation. And without going into too much details, there's actually 2 rates in a Series I bond. The standard rate is still 0, believe it or not, but the inflation rate is currently 7%, and that gets rolled out every 6 months. But the beauty is, if you buy it now in this window, you're locked in on that inflation rate for the 6 months. So again, it can vary and go up and down, but the good news is, like I said, there's a good opportunity there to get 7% out of something issued by the United States Treasury. All right, so that's something you can do on your own if you got money in your CDs or savings account and you want to do something out there and self-direct it. Now, what are we doing for our clients? Well, because we're selecting individual stocks and bonds for our clients, we actually have a great opportunity to rotate the portfolio in a direction that we think will benefit best by inflation. You see, by owning stocks individually by their nature, like I mentioned earlier, if you have prices of goods and services going up, therefore companies that make those goods and services, because they're making more money, by definition, they're going to be worth more money. Now, I really like consumer staples, things that everybody needs to buy, like toilet paper, right? Or things of that nature, that they're household goods. Because yes, those prices may go up, but people aren't going to squeeze that first. They're going to squeeze maybe going out to dinner or traveling, but they're not going to stop buying toilet paper, paper towels, soap, things that they need for normal living. And so if those companies are charging more for their goods, I would expect their stocks to go up. And again, that's one of the benefits of us in-house managing the assets. We can directly go and buy those types of stocks in the portfolio that are going to benefit from inflation. And I think that's the most important thing that you can do. So with many of our clients, we talk about this every time we review, but we have two pieces of the portfolio. We've got stocks that are in there for 5 years or later, right? So again, we don't care about the price. We do, but we don't bank on the price of the stocks from a day-to-day, month-to-month, even year-to-year. It's a 5-year and beyond growth strategy, and that's primary to outpace inflation. So that's why we have stocks in there. So your portfolio is growing faster than the rate of inflation. And then we've got the bond piece in there to help dampen volatility when the stocks get crazy, and also provide an income stream, certainly if you're retired, even if you're not retired, providing some income into the portfolio. So that's why it's important to have both with our clients. Not every client has both because, again, your situation may be a little bit more customized or unique to you. But generally speaking, most all of our clients have a stock component and they have a bond component. Stock component's going to help you against inflation. And then we can go in there on a micro version and buy stocks that are going to benefit the most from inflation. And then again, the bonds dampen volatility. Now, on the bond piece, right, because they're not keeping up with inflation right now. And if actually rates go up, the bonds are going to have a headwind on them. We can buy other types of bonds. We can buy floating rate preferred stocks, which aren't quite a bond and aren't quite a stock, but we like them because they pay healthy dividends currently. Right, tips we can revisit, but again, I don't like them today. Corporate bonds, municipal bonds, government bonds, all of those things make up a well-diversified bond portfolio, and we're managing that as well, right? So again, so things that you can do for yourself, make sure you don't have too much money in cash in your savings account. If you don't want to mess with the Series I bonds and you've got some excess cash, let us know at Falcon Wealth Advisors, because we could open up a brokerage account and buy you stocks that are going to hopefully benefit if we have high inflation, right? So again, that'll help protect what's called purchasing power so that your money doesn't erode. And I'm going to talk about who gets damaged the most by inflation right after this quick commercial break here that I'm going to roll out right now. So again, thank you so much for tuning in. I'm humbled. We continue to have more subscribers, it feels like every week, on our YouTube channel. So that's been fascinating to see grow. And if you think our content's worthy, please feel free to give a thumbs up. If you're listening to this on your favorite podcast platform, please make sure to subscribe as well. That's the best way that you're not going to miss another episode of Upticks. My business partner, Corey Bittner, has his own show called In the Money Insight that sits right here on this YouTube channel. And he also has his own podcast that you can find out there on your favorite podcast platform. I'm also out there on social media. So I'm on Facebook, LinkedIn, Twitter, and Instagram. If we're not already friends, please feel free, send me a friend request. I love expanding my network. And my company, Falcon Wealth Advisors, is on the same 4 platforms. Okay, so who is most susceptible to inflation risk? And this is probably why a lot of my clients or our clients are worried about inflation, because I would think that their parents' era are the ones that suffered the most from inflation. And people that have the most inflation risk are people that typically live off of CD interest, right? Because CDs aren't earning the amount of inflation. So their purchasing power, like I talked about already, is eroding. Or if they're on a fixed income, right? Maybe they get $2,000 a month from a pension and it never increases for inflation. Social Security also doesn't, I mean, it does have some sort of cost of living adjustment, but oftentimes that doesn't keep up with people's enhanced spending habits, right? So those type of people that have too much in savings or CDs, have a fixed pension, and have Social Security, and if that's all that they are living off of, and they're not doing Series I bonds or stocks or other things to help protect them against inflation, they're the ones that are going to struggle the most from it. So if you or someone you know is set up that way, it's like, well, I've got, you know, 200,000 in a savings account, not earning any interest. I've got a pension. I've got Social Security. It's not going to grow and keep up. You definitely highly encourage you to reach out to a fiduciary-minded wealth advisor such as us at Falcon Wealth Advisors, because we can take a look at the structure of everything and make sure your portfolio is set up to protect your purchasing power and let your money grow with inflation. Right? So I want everybody to embrace inflation. It's actually not a bad thing, especially if you have your portfolio set up to benefit. So as prices of goods and services go up, so too would we expect our portfolio, which again ends up being a wash for our clients, they have more money in their IRA or their brokerage account. Yes, they've got to pull out more money, but it's all equaled out. Don't be that client that has $500,000 in a savings account earning zero interest, right? Because again, you're just going to erode that purchasing power, and you're going to find that your nest egg and your net worth is going to slowly deteriorate with inflation. But there's things that you can do, like I've talked about, to protect you and your family. Okay, great. That's all the time that I do have for you today. I'm excited. I'm looking at rolling out some new topics for 2022. So if you or your family have any topics that you'd like me to discuss on Upticks, please feel free to send me an email at jake@falconwealthadvisors.com. I'm also excited to start bringing on more guests on the show. So if you would like to be a guest on our show or know someone that you think would be beneficial to our audience at Upticks, also send me an email. I'd love to start building out that roster and getting guests lined up for 2022. Thank you all so much for tuning in. I hope you have a great day.